For those of you that aren't yet retired, if you knew that you were going to be in a higher tax bracket in retirement, would that change the way that you're saving and investing today? Today, I want to show you why so many successful retirees will find themselves in higher tax brackets in retirement. That's even if the tax rates stay as low as they are today. Keep it right here while I explain why you may want to say goodbye to tax deferral. Good day, everybody. Chris Heerlein here of REAP Financial, host of Retire Ready TV on KXAN, and host of Wealth Radio every Saturday, 11 a.m. on News Radio KLBJ. If you enjoy our channel, hit the subscribe button down below. I drop new content here every week. Okay, so if you knew you were going to be in a higher tax bracket in retirement, would that change the way that you're saving and investing today? The interesting thing is so many retirees that work with REAP Financial, they say, Chris, if I just would have known that I was going to be in the same tax bracket or higher, I would have potentially changed where I was putting my money throughout these years. See, premise is that, you retire, paycheck goes away, and you're going to be in a lower tax bracket, but that's not the case for many, many successful retirees today. Today, I want to talk to you about why tax deferral may not be the best approach as you're heading into retirement. Maybe you're 3-5 years out. The thing is that tax deferral is really the foundation of most people's savings and retirement plans. When they rolled out 401ks back in the 80s, the idea that you could put money in, not be taxed on it today, let it cook, double, triple in value over the years, and then you could take it out in retirement when likely you would be in a lower tax bracket. That made a lot of sense. But I've been arguing that for many years since the Roth IRA and now Roth 401k are available. The thing about tax deferral is when you have money compounded in these accounts, it's a one-sided relationship. Uncle Sam is going to dictate how much they're going to basically take a rake over your wealth in the year you need to take it. Now, a lot of people, they actually will defer the taxes in IRAs and 401ks until they're actually forced to. RMDs, required distributions, kick in for families today at age 73 or age 75, depending on when you were born. And this, many cases, is when you see families go up in tax brackets because every dollar that comes out of your IRAs and 401ks is taxed at income rates, not the favorable capital gains rates. So what happens is that you approach these ages, you arrive at 73, 75, and you may be in a 12 or a 22% tax bracket. And if you have a sizable required distribution, now you're going from a 12 to a 22 or maybe a 24 to a 32. And what that means is every dollar that's now forced to come out of those IRAs, 401ks is going to be taxed at higher rates, in many cases indefinitely. It means also that your Social Security is being taxed at higher rates. You have pensions, potentially. If those pensions aren't tax-free, which most aren't, you're giving more of the pension back. And then I've talked for years about the stealth taxes on Medicare and how your income dictates your Medicare premium. So it's kind of a snowball effect. And then after the Secure Act 2.0 passed a couple years ago, the idea of leaving tax-deferred accounts to your heirs is less attractive than ever. See, before that passed, you could leave an IRA, a 401k to your heirs, basically could distribute it out over their lifetime. They called it a stretch IRA. And that was a really nice gift that the government allowed because potentially that money could continue growing every year, even though you were forced to take a small amount out every year. So when you inherit IRAs, under the stretch IRA rules, you were required to take a distribution, but it was such a small amount that we saw most families that had these inherited IRAs, they just would grow forever. But now under today's law, you leave an IRA or a 401k to your heirs, and they have to take it now over 10 years. So under current law, they can let it continue to defer. The entire account has to be distributed by the 10th year after they inherit it. So if you leave money to your heirs and they're in their 50s and 60s down the road, when they inherit that money, you're in your 80s and 90s, well, potentially they're going to be in the highest earning years. And now they're going to be forced to take money within 10 years. This also assumes that potentially tax rates could be higher down the road. As of the date of this recording here in 2024, tax rates are as low as they've been in 40 years. So if you're like me, I believe that taxes will go up. Another reason to say goodbye to tax deferral is that when you lose a spouse in late life, in many cases, your portfolio shrinks overnight because you are now filing taxes as a single filer. When you inherit or basically receive your spouse's IRA, spouse's 401k, you're still going to be required to take required minimum distribution on that. But now you're filing at single taxpayer rates, which are very unfavorable. I call this the widow's penalty. And in many cases, you see your tax bracket go up, you see your Medicare premiums go up because you don't have that favorable filing joint bracket. So these are just a number of reasons to consider the Roth IRA. And if you're still working, consider putting money into Roth 401ks. It can be a powerful way to build a foundation of tax-free money, and it's tax-free for you. It's tax-free to your heirs. And the most important thing is it gives you more control because your Roth accounts under today's law aren't subject to required minimum distributions. That's the most important reason we want to see you have these Roth accounts in your portfolio. If the majority of your portfolio is in pre-tax accounts like most Americans and you want to get in the Roth game, I want you to get your hands on our Tax Explorer Guide. It's updated for 2024. Email me right now, retire@reapfinancial.com. That's retire@reapfinancial.com, and my team will have this great guide on its way to your inbox. We'll see you next week.